All right. So take it away, Jody.
All
Introduce.
right. Hello, everyone. I'm Jodie Hatano. I am one of, I think I am the preferred lender for Mike and his team here at EXP. I know some of you may not be with EXP, but you join Mike's calls because they're so informative and you get a lot of really great information out there. Mike is, of course, very attentive to his agents. So if you have questions after this and you're not with EXP, give him a call. Today's call is going to be a little kind of short and sweet, but it's going to be kind of jam packed with some info that I think will help you guys when you're out there talking with your clients. As you all know, interest rates have come up. You have probably seen it on the news. I'm going to talk a little bit about that at the beginning, and then we're going to talk about how you refer to me, and I want to give you some tools and tips for that so that we have better retention and can kind of gauge better your clients what their level of seriousness is with buying. I know that you do refer a lot, and then people just kind of fall off. They don't return calls, they don't return messages, and we're both asking each other, "Have you heard? Have you heard?" And it's like, "No," and then all of that. So I think, well, you're not going to change someone's level of commitment by following up, but at least you're going to be able to weed out who's really committed and who's not, which will then save you more time because time is money and you need to be more efficient in this industry. So, we're going to talk about that and then we're going to talk about what I'm doing this year for the first time. I'm super excited about it and I really want you guys to engage with me on this. I think that it will set us both up for success in 2025. um, if we do the work, it's going to happen, right? We got to go back to basics. We've been talking about that for quite some time. And we're going to go over a little bit about that at the end of the call. So I'm going to go ahead and get started. Share my screen here as soon as I
Oh, here, let me
get it going. Okay.
just a second. Sorry about
Oh,
that.
okay.
I'm, you know, how about now?
All right. Let's see. Okay. Now let me know if you can see that size wise, if it's good, because I've got a split monitor going here. Is that, you able to
Looks
see
good.
that pretty easily?
Looks good.
Okay, great. Okay, so obviously my name, you know that. Okay, so we are going to talk about why are interest rates up right now? Because they are quite a bit, to be quite frank. Um, I get this question every single day. There's going to be questions about interest rate, and there's a lot of misconception out there in consumers, and maybe you guys don't maybe quite understand everything that goes into mortgage rate pricing. I don't know it all either. Nobody does, except for the guys up in Wall Street that really kind of control all of this. But I want to talk about what's going on in the market right now and how we can give our clients, borrowers, information that they need to make an informed decision about their home buying process and home selling process. So, what we're going to talk about first is the 10-year Treasury. So if you want to get a really good idea of what interest rates are doing from a day-to-day basis, or if you even want to look at the history of interest rates in general, the 10-year Treasury is really where you want to look. You don't, Fed fund rate, yes, that impacts mortgage rates, but not directly. And I'm going to show you in the next slide what happened with the Fed fund rate effect with mortgage rates after September 18th. So if we look at this 10-year Treasury, and as a matter of fact, I think this is a great chart, but I think I want to make this a little more interactive. And I'm going to actually go to the website I use. Let me know if you can see all that. All right. Can you see all that? I'm on an actual website. You can see that?
Yes, we can see it.
Okay,
Yes, it can.
perfect. Thank you so much. Okay. So this is what I look at, multiple times a day. I look at it at the end of the day to determine, do I think rates are going to go up the next day or not? So this is the 10-year Treasury, and this is just a 1 year chart. So we're comparing this time last year to this time or this current time right now. So we can see that, well, let's go back to September. There's September 17th, right before the Fed meeting the next day, right? And I've shared with some of you that I talk to on a regular basis that we have a lot of refinance clients that, want to get in and get their rate lower from what they bought last year. And so, my instruction was if you've got some savings and I can cover the closing costs for you, then we should refinance right now. You cannot or should not play the interest rate market really ever, but right now especially, it is incredibly volatile, and there is no real way to predict what rates are going to do long term. We can see from day to day what they might do, but do I know where rates are going to be in December 15th? Absolutely not. If I did, I wouldn't be on this call. I would have an island out somewhere in the Mediterranean, and I would be a billionaire if I knew that. But we can look at trends and kind of get an idea. So, what I would also encourage you to do, just on a side note here, if I can, is any of your clients that you've closed a transaction with, and it doesn't even have to have been with me, but anyone you've closed in 2022, say, spring of 2022 to earlier this year, give them a call and say, hey, I remember, we closed this transaction. How are you liking your house? How's everything going? I remember that you have a little bit higher rate, and I'd like for you to talk to Jody, my preferred lender, to see if now is a good time to go ahead and get that refinance going to save you some money. Maybe she can cover some closing costs. I'm fine with you saying that. Maybe I can, maybe I can't, but I'll hash that out with the client. So, what does that also do? It puts you right back in front of them. Again, you're bringing something of value to them by connecting them with me, someone who could potentially save them money. So, put that on your list to do. After we get off this call, I want you to do it and then email me with any referrals you have. A couple slides later, I'll talk about how to refer that I think will help. So let's go back to this. So 10-year Treasury, right before the Fed met, I was trying to get everyone to lock their refinances, and consumers, they say, oh, no, I'm going to wait till the Fed meeting. And I said, please don't do that because that's not a direct impact, but still they wanted to wait. Okay, so here's what happened. That's September 17th. And now here's the 18th, 20th, a little bit of a lull on the 27th. And then we've just gone up, 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 up. A small little dip on the 14th. When we see little dips like that, we're not really talking about interest rate movement. We're talking more about the cost of that interest rate. For example, if on this day interest rates cost 6% at 0 points, the next day 6% might cost an eighth of a point. And what is an eighth of a point? 0.125 times the loan amount is the cost of the rate. Basic math is $1 million loan, not purchase price, but loan, times 0.125 is going to be $1,250. So that means the day before, 6% was at 0 points, and the next day, 6% is costing $1,250. If it goes up a quarter, even more. It could go up half a point. We did this morning just see the 30-year go up 0.375 in cost. That's a really big number for me. I might see an eighth, maybe a quarter. A quarter is going to make me think, what's going on? What news came out that I didn't hear of? An eighth is pretty normal up and down, but going 0.375 is significant. So again, with the refinance customers, the people that you've closed in the past, let's still give them a call because it doesn't necessarily mean we can't help them because some of these people were in the sevens. How do we know that? Let's go all the way back to this time last year. See that chart right there? This was October 24th of 2023. This is when interest rates, and I'm just going to minimize this and show you here. These are the rates over the last year. So October 2023, you can see this, the 10-year Treasury was up. And this is when we saw 7.5, 7.6, even spiked up to 7.8 for a quick moment. Came back down, and you can see it's not, I can't overlap because it's not quite structured that way, but you can kind of see the way that the 10-year Treasury and mortgage rates coincide, right? If you look at the Fed fund rate, you're never going to get that kind of chart. It's not going to help you. So if you get that, people talking about that, and that chatter is out there right now, even with my own borrowers that are in process. Well, what happens if the Fed drops rates later this year? First of all, I don't know that they're going to because of where the market is right now in our economy. But what's a really good indication? Direct them away from the Fed's fund rate, preferably to me. But if they want, to know a little bit more, direct them to the 10-year Treasury. It's public record, of course, and anybody can take a look at this and see exactly what I see. So you can see that the rates were super high this time last year. And they're down about 100 basis points. That's significant in a year, even though we've seen interest rates come up quite a bit since September. If I put this chart, oh, sorry about that. Let me make this bigger again. If I, oops, I need to do that. Okay. If I take this little plus sign here, and this is, of course, today, and we look at that yellow line that goes all the way over, we can see that for the majority of the year, interest rates have been at or below the level we're at right now. So the interest rate talk that you get probably every single day, if you're talking to anyone conducting your business, show them this chart if you want to, or just let them know, hey, rates are down now. Even though they've come up a little bit, they're still lower than they were this time last year significantly and throughout all of 2024. So you Google 10-year Treasury. You can pop in CNBC. That's my favorite website because it pops up right away and gives you exactly what's going on. So we're up 0.018. What does that mean? I would venture to say that we could possibly see a rate increase later today. If not, Rocket is not as quick to adjust or to respond, I should say, to the market. But we probably will see an interest rate increase tomorrow, maybe about an eighth of a point or so, unless by uh, later this afternoon this starts to go down. But I don't really think that's going to happen. But who knows? All right, so I'm going to minimize that. And we're going to go to the next slide here. Okay, so talking about this next slide is going to show you about the 30-year mortgage rates historically from 1970 all the way to now. And I know we've talked about this a lot, but I think it bears repeating because it is such an important topic right now, and it is top of mind to buyers and sellers everywhere. That's why, we've seen such low inventories because people are holding on to these low rates and not wanting to, go from a 3.5 to a 7.5. Excuse me. But I think that they're starting to realize now, all right, this might be where we are. This might be the new baseline for a little while, and I don't want.
Jodie, I have
Oh,
a quick question.
oh, sure. Sorry.
Can you specify, are you just saying the conforming rate or the jumbo rate? Because
No, yeah, this is just conforming. So,
okay, thank you.
yeah, you're not really going to see jumbo rates charted like this. Any of these financial institutions, this is Freddie Mac right here, is going to just do the 30-year fixed conforming, and it's an average over the whole entire country. So, there's parts of the country that, the rate might be a little bit lower, might be higher. Interest rates, believe it or not, are geologically influenced as well. So you might have a different rate in Atlanta, Georgia, where I'm from, than you have in San Jose, California. So this is just an average. So it's still a good educational tool to use when talking with your clients. So one thing I want to take a note about this is, and I've done a millennials and Gen X, maybe it was Gen Z, call previously about overcoming objections from those generations about home ownership. And I think it would be important to show them this slide. And you can find this on Freddie Mac's website. Just Google it if you want. Mortgage interest rates historically or mortgage interest rates for the last 15 years. This I've got about 11 or 12 years, the top slide. So this shows us that this generation that's in the market now, the younger generations that are coming in, they've never seen rates at 18%, 12% back in the 80s when, as you can see down below that chart, right after 1980, about middle of 1982 and a half or three, rates were super high, 18%. But you can see that they've come down. And then if we look at where we are right now, it's still historically low. Now, not from the past 4 or 5 years, but we also had the pandemic that was really the driving factor in why interest rates were so low. We don't want that to happen again. We don't want another pandemic. We don't want, any horrible things happening in the world that would drive interest rates down because, that comes with a lot of suffering, of course, and we don't want that. But we do want to see interest rates come back down a little bit. I'd like to see them down pre-pandemic levels. I was locking a jumbo loan at 4.5%, no points. That would be ideal. I think we'll get there at some point. I don't think it's going to be fast. I think it's going to be slow and probably a couple, maybe 2 or 3 years even before we get to that those lower rates. So I know we've talked about this before, and I'll probably say that a lot because we have talked about this before. You know, what I've been telling my borrowers is, look, you're going to pay either an interest rate or you're going to pay in purchase price. If you sit on the sidelines and wait, first of all, you could be waiting a very long time. You've got an idea of what rate you want in your mind, but where did you come up with that interest rate, right? They say, well, I'm not going to do anything until it's 5%. Well, where did they get 5%? Um, Nobody is at 5% right now. It's going to be a while before you get there. So if they sit and wait, what if they're waiting 3, 4, 5 years and it never gets to 5%? Then they've missed out. There's that appreciation that they're not getting. They're missing out on less offers right now, although we are seeing an uptick in that in multiple offers, especially in the Bay Area and down in Southern California. So you're going to pay it in purchase price or rate. If you can afford to do it right now where rates are, let's go ahead and do it. At Rocket, I can refinance someone after they've closed once 4 payments are made, and then I can refinance them. So if we at 6.5 today and spring we're at 6%, we're going to refinance them. They're going to make 4 more payments. If the rate's now 5.5% at the end of 2025, we're going to refinance them again. Just 4 payments made in between those refinances. Do I think that's going to happen? I don't know, because you've got about 6 months in between there to see where rates go. But if we can just keep getting the more savings and more savings, perfect. Another benefit to closing with me at Rocket is that, let's say we close a transaction right now, and then this time next year rates are lower, and we're going to refi. They actually don't have to go to another 30-year mortgage. They also don't have to go to a 25 or 20-year, which the other lenders have. We have a Yorgage, if you haven't heard of that before. You actually get to pick your term. For example, someone closing right now, they've paid a year in. They don't want to do another 30-year. They feel like they're just resetting themselves. And I get that. I would feel that same way. Well, you want to do a 29-year? Yes, great. Thank you. 28, 26, 27, anything from 16 years to 29 years, they can pick. So I think that's unique. It's a unique value proposition that Rocket has, unlike other lenders. So going back to the rates. So when you're talking with your the different people, especially the younger generations, show them these charts and say, look, let's look at the bigger picture here. Rates are still historically lower than they ever have been. And now is a good time to buy if you can afford it. The next presentation that I do, well, maybe the next or the second next, I would like to give you guys some more in-depth talking points and dig a little bit deeper into how you can explain the market, what's really going on to your clients if you don't already know. Okay. Now, anybody have questions about the interest rates that I've just gone over? I don't have the slide up or the presentation up.
I have another
Michael.
question.
Oh, okay.
Hello again, it's Neil.
Hi, Neil.
Basically, if someone can bring the interest rates down and they buy down, say they have equity in their house and they sell it, so they put a larger down payment to make the price of the loan lower. Would that lower, like making the lower payment?
I am so glad you asked that. That is an amazing question. So we're going to pause for a second on this how do you refer slide. So I'm going to go back so you don't read it. Okay. So that is a great question, Neil, and I'm happy you asked it. And I'm going to give you this simple answer that you can also find online. This is public record on Fannie Mae's website. So just Google, and you might want to write this down. It's kind of a long blurb. Fannie Mae loan level price adjustments. And since you brought that up, I'm going to actually pull it up for you, and we're going to look at this because there's a lot of misconception again and with consumers on how interest rates are they get to a certain rate, and sorry, I can't type and talk. Okay. And when I try to explain this to them, I do get a lot of pushback because like, well, I thought if you put more money down, you have a better interest rate. And that's the general idea of what people think. But on conforming loans and conforming high balance loans, which is, Bay Area, down in Southern California, any of the high cost areas right now is $1,149,825. That will probably go up January. I don't have those numbers yet from Fannie Mae, but they could post them at any point in time. We do have the loan limit for conforming has gone up from 760 to 802. Now that is fantastic because conforming is always going to give us a better interest rate than conforming high balance. Now, what is that? High balance is between conforming and jumbo. So it's between 802 and then whatever the new jumbo limit is going to be. Like I said, currently it's 1.149825. So in between that is considered high balance, and that's kind of like the worst of the pricing, to be quite frank. But it is what it is. I mean, that's the where we live. So if that's what they end up getting, that's what they end up getting. But back to the loan level price adjustment. So here is this chart, and let me try to make this a little bit. Is that? Can you see that really clearly?
Yes, it looks
Yes.
good.
Okay. All right. Good. So when I look at this and I'm starting to actually have my borrowers go to this page because I want them to see that I'm not telling them to take a higher loan amount for a better interest rate because I make more money. I pretty much get a flat commission. I don't really make it. Loan amounts over 600 don't affect me at all. Up to 3 million, who cares? So when I instruct someone on, a strategy to help find that sweet spot to get that lowest rate, this is what I look at. Actually, it's built into my pricing engine, but I can see the adjustments whenever I'm talking with them. But this chart is really a great tool. So let's go with something pretty easy. Let's see. Okay, right here. Let's look at 760 credit score to 779. And let's go right here. All right. You see, it says 85 to 90%. What that means is that's the loan to value. So 85% of the loan to the value of the property. For easy math, $1 million property, $850,000 loan is a half a point adjustment to their interest rate, not the actual note rate. It's the price of that rate. Going back to if 6% today costs 0 and 6% tomorrow costs 1.25 in points, that's the adjustment. So that means that 6%, I would have to add a half a point to that cost. Okay? Are y'all following me? I know this is really detailed, but I think it's important for you to know, especially when you are referring to me and I talk to your clients about different interest rates, and I want you to be able to back me up with what I'm explaining. So does that make sense? Anybody just got a question about it? Stop me. Okay, I'll keep going. All right, so that's 10 to 15% down. Now let's look right to the left, 80 to 85%, which is going to be 15, a little over 15% by 0.01 to 20% down, which is more money down. So you think better interest rate, but look at the price adjustment. It went up 0.6 to 0.625. It went up an eighth. So on $1 million loan, the cost of that same rate would be $1,250 more than if they put 10 to 15% down. So see, it doesn't always make sense to put more money down. It just depends on kind of where you fall on this chart. So I may say to someone, how about you put a little less money down and then you'll get a little bit better interest rate? And just full disclosure, people, of course, are going to think that I'm, trying to make more money off their loan, but I'm not. But this is true, and this is what really happens. So feel free to direct anybody to this. I probably wouldn't spend too much time on it, though. It is kind of not super interesting and fun, but I might, show this to a consumer. Now, why does that price go up a little bit? It doesn't make sense, right? Because the more you put down, the better, less risk to the lender. The key is mortgage insurance. Now, this is less than 20% down. If you've got 20 or more, fine. Less than 20% down, of course, the loan has to have mortgage insurance on it. Rocket provides two different ways of paying that, either through the lender, which is the interest rate, or monthly. Most of the time, it makes sense to do it monthly because our monthly mortgage insurance is the least expensive of all the lenders out there. I know because I have access to that. So what happens is mortgage insurance is placed on that loan, and it gives the lender more coverage for that loan between 10 and 15% than it does 15 to 20% down. So with the lender getting more coverage, if the borrower were to default, that gets passed on to the borrower and a better interest rate if they put less money down and we have more coverage. Okay, so that's kind of the basics of it. We're not going to dig into this any more than this, but if you've got any questions about that and you don't want to ask it here, feel free to send me an email. All right, so we're going to move on from interest rate unless anyone else has a question. And Neil, did that make sense? Did that answer your question? Okay, I'll assume it did. If it didn't, let me know. Okay, let's close this and we'll go back to how do you refer? So, as I was saying before, how you guys refer to me, I think, is really pivotal. And what I see is some of you will send me like a warm transfer, not necessarily on the phone, but maybe an email, a text. You'll do a group text and introduce your client to me. I love that. An email is really my preferred method because I have very easy access to reference anything, any communication with that group email. I actually have a separate folder for every single borrower, and every email I put in that folder. So if we need to reference something from 2 weeks ago, I can grab that. It's a lot more efficient than scrolling on my phone and trying to find the text message where I said something to them. So warm transfer, of course, is the best way to do it. That is when you call me with your client on the phone and I answer, and then we have a conversation. That to me, we always get better traction there. But what does this do with you warm transferring, whether it's a call, text, or email? Instead of saying, "Hey, Jody, this borrower is going to call you," and then I never hear from them, or "Hey, Jody, call this borrower," and then I call, and then I have to text you. Doing this in a group uh, communication will keep us all updated real time as quickly as possible. You don't have to wonder if I called. You don't have to ask me, did you call? Did you hear from them? What happened? It's all going to be on this email. And you're going to see that if I'm emailing them multiple times and they're not responding, that you're going to know that right away. And you're going to be able to intervene, whether or not you say, Jody, they forget it, they're not interested, or, let's keep going, keep on them, let's see what we can do. This lets you know I've made initial contact. When I respond, of course, the client has all of my contact information right away, faster response time, and it gives your client a really good sense of our partnership. And they know that if you're on this email to me, then they know that there's accountability there. And I think that's important. Another way to refer, and this is sort of different than what I just talked about. This is how to get someone that you can refer to me, to get them to the point where we're going to talk about the lending options. Now, there's a lot of words here, so I'm not going to read everything, but we can create flyers, newsletters, social media posts, highlighting our partnership. When you meet somebody, if it's not a friend or family, not anyone in your sphere of influence that doesn't know you already, it's a stranger, they're probably going to Google you and they're going to want to see, what do you have reviews? What do these reviews say? If you have no reviews, but the next guy's got 25, who do you think they're probably going to go with? Probably the person that's got 25 reviews, right? Because they feel like, oh, they might have more experience. Whether or not you have more or not, they want to see that online now. Joint social media post. We've talked about this for a little over a year about you guys tagging me in your social media posts. I'll tag you. You've got a listing? Let me know. I'll post that as well. Video testimonials. If you guys want to do any type of like 1 to 2 minute, this kind of goes with the podcast as well. 1 to 2 minute, quick Q&A or something, a little market update. Then you can blast that on your social media page. You can send that off in Instagram or TikTok, whatever you use. That's going to be great. Hashtag, all that kind of stuff to get you more exposure. Review reciprocation. So this is something I want to start doing with every single closing that I have with you. Is I'm going to review you on your page, and I, of course, would like for you to review me on my page. And I want you to be honest. I want you to say how it really went. If it didn't go great, then say it. Okay, that's going to hold me accountable. But let's do that together. The more reviews we have, the better. the last thing I'll say is when you're in a client interview, whether it's buyer or seller, and if they're really coming at you with a lot of lending questions and maybe you're feeling uncomfortable because you don't know or whatever, you don't have to express that you don't know. You can say, those are great questions. Let's get Jodie on the phone real quick because she can answer them for you. And you'll be able to leave this appointment with more information to help you make an informed decision. All I need is, 10, 15-minute heads up. What would really be great is if you would say, hey, Jodie, I've got an appointment. I'm in Atlanta, actually. We did this a couple weeks ago. I've got an appointment at 1:30. Can you be available between 1:30 and 2:30 if I need to call you? Yes. So what I do is I go in and I put that that's what you're doing, and I try not to take any phone calls so that if I see your number pop up, I'm answering that phone call right away because I know that you're in front of your client and we need answers fast. The next slide. Oh, do you have any questions about that, anyone? All right, we'll keep going. The next slide is what I'm excited about probably the most going into 2025. If you guys, any of you that just got your license, you probably didn't hear this a few years ago, but at least in my world, the consensus was survive to 25 because it has been tough. It's been tough for a lot of us. Across the board, everyone's income's down, because the real estate market's taken such a punch from inflation and high rates. But that's in the past now. I just showed you, we're 100 basis points less than we were this time last year. That's got to be incentivizing for you guys to get out there, pick up the phone, go to open houses, conduct open houses, home buyer seminar. I really want you guys to do that. We've had a few scheduled and then they get canceled, but people don't really do it, even though it seems like something old and boring that was done 20, 30 years ago. Believe it or not, it's a really great way to build your book of business. Maybe the people that come to it can't buy right now, but they can buy in 6 months, maybe. I would think you'd want a paycheck in June, right? So what I want to do with you guys going into 2025 is I want to do end of year one-on-ones. And what that means is we're going to take approximately 30 minutes. If it goes over, fine. But we're going to take at least about 30 minutes on a Zoom call. And I've got a slew list of questions to ask you so that you and I can figure out our strategy to be more successful in 2025 than we were in 2024. So I'm going to do this between December 1st and 15th. So what I'd like for you to do is if you want to do this, and I think you should because I think it's not going to hurt you, I promise. You're not going to lose business over this. So why not? 30 minutes of your time. I want you to send me an email if you want to. Send me an email. Give me 3 different days and times that work for you. And then I'll check my calendar. If one of those days and time work, I'm going to book you and then I'm going to let you know. I'll send a invitation for that meeting and it'll be confirmed. And if you need to change it, we can communicate that way. My email's right there, so take that down, jodiehatano@rocketmortgage.com. A few of the discussion topics, just to kind of wet your whistle a little bit, we're going to talk about your 2024 goals. Did you reach them? If no, why not? If you did, what do you think contributed to that? We're gonna get down into the details, the nitty-gritty here. Did a lender help you meet your goals? Whether it's me or if you're talking with another lender, if you've been working with another lender, and if that lender kind of let you down on a few deals or a deal or something, we're going to talk about that and find out what happened. How could we have avoided that if you worked with me? And do you have your 2025 goals written down? Remember, if it's not written down, it's not happening. Okay, so a lot more that I have that I'll present with you on the one-on-ones, but I think it's really important to do that, and I would really love it if you guys would participate in it. Like I said, it's not painful. I'll send out the Zoom invitation, and I think it would definitely help and strengthen our partnership going into 2025. I believe, and I say it at the end of every year, the next year is going to be better. Okay. Now, 2024, 2023, maybe not production wise for everybody, but growth, right? You learned a lot. You survived. You're still here. And some of you just got into the business at a time where a lot of people are exiting, hanging their license, I'll never get in real estate again. I'm going to take a full-time job. I have a friend who closed $100 million a year for 3 years in a row, 20, 21, 22. And they just quit their job to be to something part-time. Now they made some, probably did some really good money, made some good money and was able to stash that away. But, there's like I'm over it. So people are exiting. You're in it still. You've learned a lot. You've grown a lot. This has been time to reflect and figure out, what am I made of here? Do I have what it takes to survive this part of the industry this time? And if you do, and you're still standing, and you are because you're on this call, then let's go to 2025 and make it our best year yet. Thank you so much for your time. I'll open it up for questions. Mike, if you want to take over. Thank you.
Who's over? Questions? Don't everybody blurt them out at once.
Hi, Michael.
Hello?
Hi, I have a question for Jodie.
Okay.
What is-
Yeah. So I'm just wanted to know the fee structure for her loan service for like a origination fee and if any other fee associated for the service.
Great question. As you all know, I get asked a lot to give someone a closing cost estimate. And I used to do that, okay, sure, it might be this. But what I've started to do is try to educate consumers and my realtor partners that I only have one fee. Rocket Mortgage has a processing and underwriting fee of $1,275 on conventional loans. If it's FHA, it's $2,500. Everything else is going to be third party that they're going to pay no matter where they go. Credit report fee, they're going to have to pay for that. Flood check fee, they're going to have to pay for that. Title fees, lender title policy, all of that is all third party. I have no control over that. And that is a really challenging conversation to have with borrowers because they think that I can manage those fees and I can waive those fees or I can reduce those fees, and I can't. I had a really, really tough call last week with someone who was actually under contract and was getting really, a high energy into the title fees. And I kept saying, I really don't know their title fees. I have to order them. So when I get a contract and I get the title agent name and number, I call them or email them usually with you copied, and I ask for their fees and I give them the loan number. The main cost with closing that affects the loan number is the lender title policy. So I do have to find out what they sell theirs at and how much the owner title policy is. So I think Brandon is with Chicago Title. He's part of our team. He has an app. I use it. That's what I use all the time. Because at Rocket, can't produce a closing cost worksheet. I can produce a loan estimate, which is really what the borrower needs to see because that is what ties the lender disclosing to what the fees are going to be. Now, the title fees will be estimated at the very beginning, but then they'll get a subsequent loan estimate, usually when the appraisal comes in or if there's some type of change. If they want to reduce their loan amount or increase it, things like that, they would get a new loan estimate. So to simply answer your question, I have one fee, $1,275. In some cases, I can lender credit that. It depends on every specific borrower's pricing, profile, what the credit score is, loan to value, property type, occupancy, all that kind of stuff. So 1225 or 1275, that's it. 2500 FHA.
Okay.
Everything else is
And
third party.
one more, I see. One more question. Do you help borrowers for PMI shopping?
Well, you can't shop PMI. So
Oh, okay.
yeah, so if a lender gives you a quote for PMI, that's going to be your PMI. Consumers cannot shop that around. I
I
have a
see.
tool that I can look up the national average of what other lenders pay or charge, and mine is always lower.
Okay, great. Thank you, Joe.
Yeah, you're welcome. Newsletter. Hi, I don't have a newsletter. I should work on that. I just haven't really had time, to be quite frank, to get that up. But I should, and that's something, what thank you for saying that. I am going to put that on my list of setting myself up for success in 2025. And I'm going to do an every, what do you think? Every Friday. I don't want to, one of the things about newsletters is I don't want to just, blast stuff at you and, copy and paste just some generic bunch of market stuff that really I don't even understand half of it. I want to give you guys really good information. So is weekly good? Would you like that every week or, monthly? Let me know kind of in the chat box what you prefer. I can make a commitment to send, something out every week, every Friday afternoon going into the weekend. Does that sound good? Anybody want to say yes, no?
We're getting a weekly, a bi-weekly,
Twice a
a,
month,
a month,
monthly,
that's sort of
weekly.
bi-weekly,
Okay.
monthly.
Bi-weekly. I'm assuming that's bi-weekly. Weekly or
Or
bi-weekly. All right. Let's keep going. Michael Pine, you might be, oh wait, you said weekly. Okay, good.
I,
JD, you might get more from me than monthly,
uh,
weekly. Okay. Enough said. Thank you so much. I will do this then every Friday. I will commit to starting that the first week of January. I don't think that my production right now will give me enough time to get all of that set up the way I want it to go out to you by the end of this year. If I can, great. I also have a tool that I can send out a video message to you all, and I can blast that every Friday, which might be a little bit more interesting than just a quick little newsletter with a bunch of blurbs on it. Um, so maybe I'll try that. And then you guys, I welcome feedback. So let me know if you like it, if you don't like it. But I will commit to doing that the first Friday of January. You will receive your first weekly update, whether it's a newsletter or a video from me going forward. Thank you so much. Who I can't remember who said that, but thank you.
so what, I
Yeah.
met a loan agent at 4 or 5 offices ago, pre Jody. And I still get a weekly email from him about what's happening with rates and little economic news. And
Mhm.
the part that I think would be most valuable to a real estate agent is what would they say to a client asking, so what's going on with interest rates? Right? Are they
Yes.
likely to go up or likely to go down? What's going on? And that could be, even if it was a short message, would be a weekly. I mean, they could use that every day. But, I'm just saying, once a
Yeah.
week, this is where we're going up, it's going down, it's about the same, that's my thought about it.
That's a great. I love that. I'm going to do that. I just wrote down weekly scripts. So what I would do then is in my either I don't know, video or newsletter, maybe both, who knows. But I will give you like end of the week scripts to use going into the next week that can give you just some really brief, high level what happened in the market this week. So you're at an open house and someone asks you, you can just repeat and continue on. So that's great. I will do that.
And right now, a script that you could call everybody that you know and tell them that ask them if they're interested in refinancing. Ask them if they'd like to save money. And although that doesn't generate necessarily immediate business for you as a real estate agent at that moment, you're being a real estate agent, you're being a real estate resource.
Right.
And
And you're staying in front of them because
yeah,
maybe they forgot and then you call them and they're like, oh yeah, that's right. Whatever you helped me buy. And hey, while I've got you on the phone, my cousin is moving to California and needs a real estate agent. I mean, that would be ideal, right? You don't know if you don't call.
right. So cool. All right.
Call.
They like the video idea and it's weekly.
Okay.
I think that's the way
Okay.
to
I'm
go.
probably going to do both.
All right. People don't read anymore. You do know
Yeah.
that, right? Nobody reads anymore.
Yeah.
It's
Look at
podcasts.
pictures.
In fact, it's got to be like a TikTok video, or a reel or a short, really short, right? That's what.
Yeah. Like 30, like maybe 20 seconds or so,
Yeah.
30 seconds.
It's going on.
Michael, I think you should start a TikTok channel, Michael. You could be the next star.
Okay.
For sure.
I actually have one, but okay. I think we're done.
All right. Thank you all. If you need anything, give me a call. I'm working all weekend.
Bye.
All right.
Thank
Survive to
you.
Thank
25.
you.
Okay. Talk soon.